Welcome back to We Are Cosmic, the channel where we break down the hidden forces behind crypto markets so you can think like institutions, not like the crowd. If you are holding XRP or any major asset in 2026, this message is important because most retail traders believe they are trading price, but in reality, they are fighting a psychological war. And the opponent, it does not sleep. It does not panic. It does not feel boredom. It does not feel regret. It is the system. Let me explain something clearly. When you stare at a stagnant price like $140 and feel tempted to sell your XRP to chase the latest AI meme coin, that feeling is not random. That is pressure. That is engineered boredom. Smart money understands something most retail traders don't. Humans hate sideways markets. Humans crave excitement. They crave volatility. They crave action. So what do institutions do? They remove the excitement. They flatten the chart. They create silence, and they wait. While you get bored, they accumulate. This is not just a price chart. It is a map of psychological pressure. Think about it. Since the beginning of 2026, XRP has been moving in a tight range. No massive breakout, no dramatic crash, just slow, controlled price action. Meanwhile, meme coins are pumping 50%, 100%, sometimes 300% in days. That is not coincidence. That is capital rotation bait. High volatility meme coins act like shiny objects designed to pull impatient money away from long-term institutional assets. Every time you sell XRP to chase a pump, someone on the other side is quietly filling a large buy order. That is the opportunity cost trap. It is a transfer of wealth from the impatient to the patient. Here's what makes this more interesting. Despite the boring price action, decentralized exchange volume is hitting record levels. ETF inflows have been strong for weeks. Large wallets holding over 1 million XRP are at an all-time high. Ask yourself this: if nothing is happening, why are the biggest players increasing their positions? Because boredom is their weapon. Institutions do not buy during vertical green candles. They do not buy when social media is loud and euphoric. They buy when you are tired. They buy when influencers move on. They buy when you start questioning your decision. This is the boredom phase, and historically, this is where the biggest accumulation happens. Look at the divergence. Retail sentiment is falling, but whale wallet growth is rising. That means while small holders are exiting, millionaire wallets are increasing. If you sell now, you are not just closing a trade. You are completing someone else's buy order. The market is not designed to make you lose money. It is designed to make you lose discipline. Once you understand that, everything changes. Now, here is my question for you. Are you trading with emotion, or are you building like an institution? Drop a comment below. Are you accumulating, or are you waiting for excitement? 4 days ago, XRP dropped nearly 15%. To the average trader, it looked like collapse. Social media turned red. Influencers started questioning strength. Panic spread fast. But professional capital does not panic. It plans. That drop was not random selling. It was a liquidity event. Let me explain something most retail traders never understand. Big players cannot simply buy hundreds of millions of dollars worth of XRP at market price. If they do, price explodes upward and they suffer massive slippage. So what do they need? They need sellers, not just a few, thousands. And they need those sellers to sell aggressively. That is where stop loss hunting comes in. When price was pushed into the $130 range, it triggered layers of automated retail stop-loss orders. These were not emotional sells. They were mechanical sells, pre-programmed exits sitting below support levels. Once price touched that zone, the cascade began, liquidation clusters lit up, forced selling hit the market, weak hands were flushed out, and while retail was panicking, whales were absorbing. This is called clearing the board. The drop itself is not the story. The reaction is the story. During that move, RSI hit 27. That is deeply oversold territory. Historically, that level signals extreme fear. And what happens during extreme fear? Retail exits, institutions enter. Since the beginning of 2026, we have seen a net increase of dozens of wallets holding over 1 million XRP. That trend did not slow during the crash. It accelerated. While price was falling, millionaire wallet count was rising. That divergence is not weakness. It is accumulation. Understand this clearly. The exit liquidity trap works like this. Big capital needs a wave of emotional selling to build positions without moving price up. They need fear. They need headlines calling the asset dead. They need doubt, because doubt creates supply. If you sell in panic, you are not just protecting yourself, you are providing discounted inventory to someone with a 3-year horizon. Now look at the bigger structure. Exchange reserves are at multi-year lows. That means tokens available for immediate trading are shrinking. So when retail sells during a panic, those tokens are often absorbed and moved off exchanges into cold storage. That reduces future sell pressure. So ironically, the crash strengthens the long-term setup. Here is the hard truth. If you cannot handle the shakeout, you will never see the breakout. Markets test conviction before they reward it. The 15% drop was not a signal that XRP is weak. It was a signal that liquidity was harvested. The game is not about who is smartest. Most traders obsess over candlesticks, red and green bars, and daily percentage moves, but institutions don't. They look at who is holding and how much. That is the real market signal. Since the start of 2026, the number of wallets holding over 1 million XRP has reached record highs. That's not luck. That is deliberate accumulation. While retail traders panic, checking balances every 5 minutes and reacting to social media hype, these large holders are quietly building positions. This is what I call the mirror effect. Retail fear creates opportunity for cold, calculated buying. Every time you sell in frustration, you are providing liquidity to a whale. Every red candle you panic over is a buying signal for the patient. It's a psychological chess game. Retail traders think they're making moves, but the elite are controlling the board. Here's another important factor. Exchange supply is shrinking. XRP moving off exchanges into cold storage is not just a number, it is a countdown to a supply shock. When liquid supply drops, even minor buying pressure can push prices dramatically higher. This is why understanding supply dynamics is more important than watching charts. Now, consider the institutional mindset. They do not chase pumps. They do not react to FOMO. They plan around slow, boring, sideways markets. They buy when retail abandons the trade, when sentiment is negative, and when price appears stagnant. That's how they build a financial moat. Patiently, methodically, silently. The data confirms it. Divergence between retail sentiment and whale accumulation is clear. While small holders are leaving, large wallets are growing. The takeaway is simple. The market is structured to transfer wealth from the impatient to the patient. If you want to think like an institution, you need to shift your mindset. Stop reacting to every minor movement. Stop chasing hype or attempting to catch the top. Start analyzing wallet activity, ETF inflows, DEX volume, and the overall distribution of supply. These are the signals the elite act upon, and they are not visible on standard price charts. In practical terms, this means you need to ask, who benefits if I sell today? Who benefits if I panic? Once you answer that, you understand the flow of capital. You stop being exit liquidity and start becoming a stakeholder. This also introduces a critical concept for 2026, liquidity traps in reverse. Normally, traps catch buyers at peaks, but when supply dries up and whales have accumulated offline, the trap can catch bears at the bottom. Every sell order from frustrated retail traders is absorbed, reducing future sell pressure and setting the stage for explosive upward moves. Here's the mindset shift you need. Stop focusing on the fear of loss. Start focusing on the opportunity of ownership. XRP is no longer just a speculative token. It is becoming a global financial utility. Its value comes not just from price, but from its role in cross-border settlements, institutional credit, and tokenization of real-world assets. If you continue chasing pumps or panicking at every dip, you are playing the short-term game. But if you understand accumulation, supply dynamics, and utility-driven demand, you are now playing the long-term game. This is the game that creates real wealth. In 2026, XRP has evolved into a comprehensive financial operating system. It is no longer just a payment rail. It now supports real-world asset tokenization, institutional lending, and zero-knowledge privacy layers. These are not minor upgrades. They fundamentally change how institutions can move and manage capital globally. Take the XLS66 lending protocol, for example. This allows large players to earn yield on XRP holdings while minimizing risk. They can now access fixed-term credit, securely settle transactions, and even use XRP as collateral for broader financial operations. This is the kind of utility that traditional banking systems have struggled to implement for decades. Meanwhile, decentralized exchanges, DEXs, are recording over 1 million transactions per day, and daily active users are hitting 1.45 million. This is real usage, not speculative wash trading. Every transaction represents actual value moving through the network from settlements, credit lines, or tokenized real-world assets, which increases the underlying demand for XRP. Now consider this. The supply on exchanges is shrinking. Tokens are being moved to cold storage, creating scarcity. Combine this with rising institutional adoption, and even small inflows of capital have an amplified effect on price. This is what I call the institutional multiplier effect. $1 of demand in a low supply environment can impact the market value 10 to 20 times more than in a liquid market. Let's break this down simply. If XRP is acting as the bridge currency for trillions in global financial flows, its value is tied not to speculation, but to the actual volume of money moving across the ledger. The more institutions rely on XRP for settlements and lending, the more essential it becomes, and the more restricted the available supply gets. Here's the key takeaway. Utility-driven demand creates non-linear price movement. It doesn't follow traditional market cap logic. You can't calculate its ceiling by comparing it to other coins or assets. Instead, price responds to network usage, supply constraints, and institutional adoption. That's why understanding utility is more important than obsessing over charts. And there's more. XRP is solving problems that have held back global capital for decades. Nostro and Vostro accounts, billions in trapped liquidity, are finally being unlocked using XRP's settlement capabilities. Real-world asset tokenization is live on the ledger, from real estate in the Balkans to carbon credits. Institutions now have a compliant, private, and yield-generating infrastructure at their fingertips. So ask yourself this: are you watching candles, or are you understanding the rails of global finance being built under your feet? This is the difference between being a speculator and a stakeholder. Speculators chase short-term gains and hype. Stakeholders understand infrastructure, scarcity, and long-term adoption. They position themselves not for the next meme coin pump, but for real ownership in the financial system of the future. Let's start with exchange supply. XRP held on exchanges is at an 8-year low. Tokens are being moved into cold storage or institutional wallets, reducing the amount available for trading. This is crucial because when liquidity is tight, even small amounts of buying can cause large price moves. Imagine a crowded theater where only a few seats are left. Everyone rushing in pushes the price up rapidly. That's exactly what is happening in XRP right now. Next, let's talk about ETF inflows. Since early 2026, XRP-based ETFs in the US have recorded a 55-day streak of consecutive inflows. Institutions aren't buying randomly. They are accumulating XRP consistently, building long-term positions. While retail traders panic over sideways charts, these inflows quietly pull massive amounts of XRP off exchanges, creating a supply vacuum. Here's how the mechanics work. Retail traders panic and sell into small dips. Institutions absorb those tokens quietly. XRP leaves exchanges and enters cold storage, effectively removing supply from the market. With supply shrinking, even modest demand triggers explosive price moves. This is why understanding liquidity is more important than looking at price. Price can lie, supply cannot. Now consider sentiment. Social media often signals extreme greed or fear, but in February 2026, the loudest retail voices are not the smartest. When everyone is calling for double-digit gains by next week, that's usually the peak of risk. Institutions see that as a cue to remain patient, not to panic. Extreme retail hype often sets the stage for a sell-the-news correction, while sideways price action gives them the opportunity to accumulate even more tokens quietly. Let's tie this together with the liquidity multiplier concept. Because exchange supply is low and ETF inflows are steady, every new dollar of institutional demand has an amplified effect on price. This is not speculation. It is structural. One large buy order can absorb most of the remaining liquid supply, forcing price to climb quickly. Also, keep in mind Treasury unlocks. Major institutions have scheduled portfolio rebalances in the second half of 2026. If the market cannot absorb these injections of XRP, temporary corrections may occur. This is why supply-side monitoring is just as important as demand-side analysis. Understanding when supply will tighten or increase allows you to anticipate volatility and avoid being caught off guard. The key takeaway: you want to be on the right side of this liquidity vacuum. If you sell in fear, you provide the tokens that institutions are collecting. If you understand supply dynamics, you can position yourself as a stakeholder, not as exit liquidity. Remember, the next big move won't come from hype. It will come from structural forces. shrinking exchange supply, ETF inflows, institutional accumulation, real-world utility adoption. Those are the levers that create true price momentum, not the red candles that dominate social media feeds. The first thing you need to know, holding is not passive anymore. Holding XRP today is not just about hoping for a price pump. It's about participating in a financial network that is being built under your feet. You are moving from a gambler's mindset to a stakeholder mindset. Instead of focusing on short-term gains or hype, you focus on ownership, yield, and long-term structural value. Here's the first rule. Scale your position gradually. Do not dump all your tokens at once when price moves up. Instead, plan tiered exits at key psychological levels. For example, you can take small profits at every milestone, 5%, 10%, or 15% gains, while keeping the bulk of your position invested. This way, you secure your initial investment early, reduce emotional stress, and stay positioned for the next major move. Next, focus on liquidity and redundancy. Exchanges can face outages, KYC issues, or regional restrictions. By creating multiple verified accounts across platforms, you ensure you can act when opportunity strikes. This redundancy allows you to execute trades without being locked out, giving you the flexibility to scale up or take profits at the right time. The third rule is ignore the noise and focus on structural signals. Stop obsessing over social media hype, speculative price targets, or short-term FOMO. The real signals are ETF inflows, whale accumulation exchange, supply levels, daily transactions on the XRP ledger, real-world asset tokenization volume. These metrics tell you where the smart money is moving, not where the crowd is panicking. Next, understand risk management. Even with strong fundamentals, temporary corrections can happen, especially during treasury unlocks or extreme retail hype. Use stop losses or tiered position scaling to protect yourself, but don't let fear push you out of a long-term stake. The goal is not to avoid every dip, it's to stay in the game while positioning for exponential growth. Now let's talk about psychology. The hardest part is holding through green candles. Everyone wants to sell when price rises, but the real opportunity comes when you scale and compound during strong moves, while other traders exit prematurely. This is how wealth is created, not by timing the bottom perfectly, but by staying positioned through cycles, capturing gains, and reinvesting strategically. Finally, embrace the stakeholder mindset. This means viewing XRP as ownership in the infrastructure of global finance. The ledger is now a settlement layer, a lending platform, and a tokenization engine. Holding XRP gives you a stake in the system itself, not just a speculative coin. The difference is profound. Stakeholders benefit from network growth, utility adoption, and scarcity, while short-term traders only benefit from temporary price swings. So here's your 2026 blueprint. Understand accumulation and supply dynamics. Don't panic during sideways markets. Watch institutional inflows, whale wallets, and exchange supply. These are the real market signals. Scale your position gradually and plan tiered exits. Maintain redundancy across exchanges for liquidity access. Focus on utility-driven demand and long-term network growth. Manage risk, but embrace the stakeholder mindset.